All right, this is SoFi. So the ticker symbol is SOFI. For right now, the stock is trading around $18. The company is worth about 23 billion with the current market cap, and it is sit near like 40 times earning as of right now. SoFi started as a student loan refinancer, and it has turned into a full digital bank that has that does lending, checking and savings, investing, and so on. Even a tech that breaks powers to other fintech companies. So today I'm going to break down how it makes money, the latest numbers they have, the real risk for SoFi, and whether the price really makes sense, especially since the stock's actually down this year. First, so the headlines for the latest news, SoFi just had a record quarter with revenue of $1.1 billion. They're up 43%, and the profits that more than doubled since. And yet the stock is down about 37% this year, which is a clear valuation reset. The newer story is product. In May, SoFi launched its own stablecoin, the first from a US national bank, letting about 15 million members to move dollars to Ethereum and Solana inside the app. In June, it added Composer, an AI investing tool, and membership hit record about 14.7 million. So for the executive summary, so here's a summary in the plain terms. In one line, SoFi wants to be a single app for all, basically all in one, lending, banking, and investing, and also tech behind other fintechs as well. But the case for the buying, members are growing 35% a year. The mix is shifting towards steadier fee revenue, and a bank charter gives a cheap deposit that apps only rivals lacks. The case to worry is that rich valuation is near 40 times price earning ratio. The credit risk every lender carries, and the fact that the stocks already fell 37% this year. Bottom line, this is a real fintech grower with a bank underneath, priced like a tech stock. The growth is real. The valuation is a catch right now. All right, so for the business model for SoFi, so how does SoFi actually makes money? So they actually have three parts, which is pretty self-explanatory. About half is actually lending, personal loans, student financing, and home loans, which is the original profit engine for SoFi. About a third is financial services, the checkings account, savings account, card, and investing products funded by cheap deposit and it's growing fast. They also have a small slice, but maybe the most interesting one is the tech platform Galileo Technici. The back end is plumbing the power to other fintechs and banks as well. The moat is the bank charter plus is an all-in-one app. All right, the numbers. So now the numbers they see in the chart. The net revenue climbed from 2.1 billion in 2023 to 2.7 billion in 2024 and to 3.4 billion in 2025. So in the first quarter of 2026, the revenue actually hit 1.1 billion. They're up 43%. The profit was 167 million, more than double the year before. Members have reached roughly 14.7 million. The honest caveat is that the profit, while the real and growing is fast, is still small, next to 23 billion price tag, which is exactly why the stock swings so hard on the settlement. So here's where it matters the most, it's like how the money works. So SoFi is really in the two business in one. One side is fast growing fintech company that earns steady fees from its tech platform and from selling loans to other investors. The other side of it is a traditional lender that holds loan to its own books, which carries credit risk and move with interest rates. It has more than 30 billion in cheap deposits, and they are funding those with loans. When the economy is strong, both sides hum. In a downturn, The lending side is where the trouble shows up first. All right, for the capital allocation, so what about the money it makes? So currently right now, SoFi don't have any dividends because this is still a quote unquote growth company. And the capital goes first into funding loans, growth, and building new products like stablecoins, which is just started not too long ago, and the AI tool that the one thing is to watch duration. The share count has grown over the years from stock-based pay to old convertible notes, though that is improving now. Now that profits are consistent, the bet is simple. So scale over payouts. So if the membership and fee keeps compounding, it'll work. All right. So for the macro and the market itself, so if you zoom out real quick to the bigger forces, the tailwind is actually young, digital first generation leaving the first generation leaving the traditional banks, and SoFi is chasing them with crypto, stablecoins, and also the new AI tools that they have. The risks are classic banking. Personal loans are the core, regardless. So a recession that lifts defaults is the single biggest threat, not only for SoFi, for anybody, for the fintech or banking industry. Margin and loans demand both move of interest rate, and as a full national bank now, SoFi face a real regulation, plus a fresh scrutiny on anything that is crypto related as well. Alright, so for competitive position, so where does it stand against like rivals, next to like JP Morgan or BOA, Bank of America? So SoFi is actually really tiny, but it is far better than designated and built for younger users who want one app on one app. Against fintech companies like Chime, Cash App, and also Robinhood. Its edge is owning a real bank charter, which most of them do not have, at least for right now. And here's the clever part. So through Galileo, SoFi powers some of its own competitor and earn fees as they grow. Its profit from the whole fintech wave, not just its own app alone. All right, so the risks that they have for SoFi. So there are four risks to keep in mind actually. The biggest risk, obviously, is the credit. So SoFi is still mostly a lender, so a recession that drives up, loans, defaults, profits directly. Second is the valuation. So again, they're trading about 40 times price to earning ratio, so it's quite rich, and they're down 37% compared to last year. And that really shows how fast they can really reset the valuation. Third is the sensitivity, since both margins and loans demand move tied with interest rates. And lastly, the fourth one is their duration and competition, because the share counts keeps growing and the rivals are like everywhere and they're gonna keep growing and growing. All right, so for the bull, neutral, and bear cases, so what has to be true for each path? So for the bull case, memberships keeps compounding, the capital lights fee keeps compounding, business scales up, credit stays healthy, SoFi grows into a valuation as a real diversified platform. As for the neutral case, growth stays solid, but the multiple stays under the pressure, so the stock chops sideways while earning catch up. For the loser side, the bear case, a recession spikes loan losses. Growth slows, deterioration continues, and a premium multiple on a lender wins hard. So to end with this, SoFi is actually a rare thing, a fintech company that actually became a profitable bank. They growing members at 35% a year, while also quietly building the plumbing behind other fintech companies. The catch is that it is still priced like a tech stock, while the other big chunk of it is also like what they're doing is old-fashioned lending, which is why a record quarter can come with a falling share price. But yeah, that's really pretty much it for SoFi what I did. So yeah, all right, thank you. Bye bye.